Hello and welcome to lecture number 4. We'll be covering dividends and payout policy found in chapter 17 of your book. Let's dive in. The key concepts and skills that we'll be discussing through this lecture in relation to dividends and payout policy. We'll first define the dividend types and how dividends are paid. We'll explain the issues surrounding dividend policy decisions, what things to consider as financial managers, and we'll describe the difference between cash and stock dividends. Finally, we'll explain why share repurchases are a potentially good alternative to dividends. The main question that we would have in relation to dividends and paying out to investors are, would we be better served to keep the cash in the company and invest it and try and grow value for the investors in that way? Most mature companies that their growth prospects, while still good, have slowed, will tend to start to pay dividends as a way to increase the value of their stock. And we'll talk a little bit about how that is done. So let's jump into our first type of dividend, which is a cash dividend. Cash dividends, there's a few different types. There are regular cash dividends, and these are cash payments made directly to stockholders, usually each quarter. So quarterly dividend to stockholders. And stockholders will buy stocks on purpose that pay regular cash dividends. Then there are what we call extra cash dividends. And the word extra it shows that it may not be repeated in the future. It's an extra cash dividend on top of the regular cash dividend. We have dividends that we call special cash dividends, and these are similar to the extra dividend, but definitely will not be repeated. So these are one-time. Management makes it clear that the dividend is special and is not expected to be repeated in the near future. Finally, we have a liquidating dividend where cash can be returned to investors. Some or all of the business has been sold, and the cash then is given to investors. So those are the cash dividends. Dividend payments have a timeline. There are some very specific dates that you should be aware of and know the difference between each of the different types of dates. So the first date we have is the declaration date, and the board of the company is the one that approves the dividend. So the board declares the dividend, and it becomes a liability of the firm at that point. It's made public, and they set an amount typically at that point, and will announce the other dates. So we have the ex-dividend date, which occurs 2 business days before the date of record. And we'll talk about the date of record here in a second. The ex-dividend date, though, is, as an investor, a very important date to be aware of. So if you buy stock on or after this date, so even if it's on that date or the days after that date, you will not receive the dividend. That's the ex-dividend date. That's why we call it X. So from that date forward, you will not be receiving it if you buy the stock on that day or after. And that's just that next quarter's dividend. So the following quarter's dividend, you would get it, but if you were buying it to try and get the upcoming dividend, you need to buy it before the ex-dividend date. The stock price generally drops by about the amount of the dividend, usually a little bit less because of tax reasons, but the stock price will drop by the amount of the dividend, because that amount is now guaranteed to go out to the current shareholders, and so that price drops by that amount. The date of record, holders of record, so people who own the stock and are on record of owning the stock, are determined on the date of record, and they are the ones that will receive the dividend payment. So we've got the ex-dividend date occurs 2 business days before the date of record, and then the date of record those holders will be the ones to receive the dividend payment. And then finally, there's the date of the payment, where the checks are actually mailed. And so these dates and when you invest in the stock really affect whether or not you'll receive this upcoming dividend. So here's an illustration, and you can see here, this is our ex-dividend date. And so we start here, and this is found in your book in figure 17.2. This is the price behavior around the ex-dividend date. So we're assuming before the ex-dividend date, the stock is trading at $10. So we've got time 0 is the ex-dividend date, -1, -2 days, going back. So it's $10 all the way up to the ex-dividend date. The dividend will be $1. And so for simplicity's sake, we're going to just illustrate it very straightforward. The stock will drop in price by the amount of the dividend or close to it. And from that time forward, it'll now trade at the new $9 a share price. Okay, so the question is, does dividend policy even matter? You know, do we care as financial managers about the dividend policy? So dividends do matter because it affects the value of the stock. The value of the stock is based on the present value of expected future dividends. We went over this in Finance 3250 and the valuation of a stock. And so we do know that dividends do affect the value of the stock, but actual dividend policy may not matter, and we'll talk about why this is. The dividend policy is the decision to pay dividends versus retaining funds to reinvest in the firm. So we're looking at the value of the firm. So if we don't pay it out, what are we going to do with those funds? If it's just going to sit in cash, then yes, it would be better to pay it out. But if we can reinvest that cash in the firm and grow the firm, then it may not matter whether we pay that money out or reinvest it based on valuation. So in theory, if the firm reinvests capital now, it will grow and can pay higher dividends in the future. So here's an illustration of why dividend policy could be considered irrelevant. So let's consider a firm that can either pay out dividends with one of two plans. So plan 1, they can pay $10,000 per year for each of the next 2 years, or they can pay $9,000 this year, reinvest the other $1,000 into the firm, and then pay $11,120 the next year. So, and we are assuming that investors require a rate of return of 12%. So this is our discount rate. So we're going to compare the market value of these two plans. The present value of plan 1, if we calculate it, and the notes to this slide, if you download the slides, have the present value calculation. But the present value is calculated of these dividends for the 2 years of $16,951. If we look at plan 2, the present value of growing dividends with reinvestment, so that one we paid a lower dividend the first year but pay a higher dividend in the next year. Again, we show that the present value is the same for the investor. So it really may not matter, all things being equal. So if the company will earn the required return, then it doesn't matter when it pays the dividend. So there are some arguments for having a low dividend payout and some arguments for having high dividend payout. So we're going to first go through the arguments for low dividend payouts. Why might a low dividend payout be desirable? First, individuals in upper income tax brackets might prefer lower dividend payouts given the immediate tax liability. So when an investor receives dividends, they are liable to pay tax on that that year. And so they would be in favor of higher capital gains, which means rather than pay out the dividend, reinvest the money and they can put off the capital gains tax for when they actually sell the stock. Dividends are paid, tax on dividends are paid in the year that the dividends are received, but capital gains tax isn't paid until you actually sell the stock. So you could own the stock for years and not pay the tax until you sell it. Also, flotation costs. Low payouts could decrease the amount of capital that companies need. So let's say that they have some future projects and they could finance those projects either through their internal generation, their net income that they've received, the internally generated cash, or they could issue stocks or bonds. Well, the cost to issue stocks or bonds is what we call flotation cost. And so if we pay out low amounts of dividend, we've got a capital around, and so we wouldn't need to raise any or as much, and so it would lower the flotation costs potentially. Finally, there are often, in relation to debt that a company takes on, there are often dividend restrictions. So if a company goes out and borrows, say, a few $1,000,000, the bank lending them that money might require that they can only issue dividends up to a certain percentage of income. And that guarantees to the lender that there's going to be cash available to pay back the debt. So think of a situation where if there were no dividend restrictions and owners knew that things were not looking good, rather than pay the debt, they could quickly pay out all of the existing cash out to shareholders so that they wouldn't have to pay the debt. And so it's not uncommon to see dividend restrictions when there are debt contracts. Okay, so why might a high payout be desirable? Well, there are individuals and companies that might desire current income. They want the dividends, they need them. When I worked in investments, I had clients who were retired and they were living off of dividends and interest payments from their bond investments. And so they relied on those dividends. It was part of their monthly income or quarterly income. Individuals that need current income, such as retirees, or groups that are prohibited from spending principal. So the trusts and endowments can be set up in such a way that you cannot draw from the principal amount. So let's say you've got a $25 million endowment. Maybe the endowment is only allowed to distribute whatever earnings it has. And so groups that are prohibited from spending principal would be interested in having current income generated from dividends and interest payments. Also, there's some uncertainty about future. There's no guarantee that the higher future dividends will materialize, and so they want the payout now rather than waiting, because what if something happens to the company in a couple of years and they have to lower the dividend or discontinue it? I want the money now. And so a lot of investors are that way. Tax situations, there is a dividend exclusion for corporations that makes it so they do not have to pay taxes on those. Also, tax-exempt investors don't have to worry about differential treatment between dividends and capital gains. And so if you're a tax-exempt investor, such as a retirement plan or those types of things, you may not care about the potential tax that others may pay. You want the dividend right now. So those are some reasons why we might want a high payout. Dividends also send signals from the company to potential investors and others. So there's asymmetric information. We covered the meaning of asymmetric information in Finance 3250, but in this example, asymmetric means it's not symmetric, so one side has more information than the other. In this case, managers have more information about the health of the company than the investors do, which is an obvious thing. So changes in dividends can be a signal. They convey information to investors. So dividend increases, it might convey the signal that management believes that these dividend increases can be sustained. So that's a good sign that management thinks that the future is bright. Expectation of higher future dividends, increasing present value. So as we expect higher dividends in the future, the present value of those future cash flows will increase and make the value of the stock higher. Also, it signals a healthy growing firm. So those are signals that we would want to see or expect when we see a dividend increase. What about dividend decreases? It signals that management believes it can no longer sustain the current level of dividends. And I read some news this morning in relation to COVID-19 and future dividends from certain companies. And so some companies are talking about suspending or lowering their current level of dividend. Expectation of lower dividends indefinitely will decrease the present value. So if it's just a short blip, we're going to lower the dividend this quarter, but next quarter this is going to happen, and so we'll be able to go back to our original dividend level. That may not have as much impact on stock, but if it's indefinite, meaning it could go on forever, it'll certainly decrease the present value of the stock. Also, it signals that the firm is having financial difficulties. It cannot meet this dividend obligation or expectation. There's an effect that we will discuss that can relate to dividends. It's called the clientele effect. And we've already discussed this, why some investors would want high dividends, why some investors would want low dividends. So they're clients. The clientele effect is each client has their own personal preference. So some investors prefer low dividend payouts and will buy stock in those types of companies. And some investors prefer high dividend payouts and will buy stock in high dividend paying companies. So what are some of the implications of the clientele effect? Well, what do you think will happen if a firm changes its policy from a high payout to a low payout? So they've been paying high dividends, now they're going to not pay high dividends anymore. And let's assume everything else is equal, it's still a high quality firm. What do you think will happen if a firm changes its policy from a low payout to a high payout? So if this is the case, does the dividend policy matter? So let's discuss each of these. So if a firm lowers its payout, then investors would just sell that stock. If investors are wanting a high payout, they'll sell that stock and buy a different stock that has a high payout. If investors want a low payout and want the company to continue to invest and reinvest those funds, but then the company starts paying a high payout, then investors will sell that and buy companies that have a low payout. So in this sense, dividend policy doesn't matter. This is similar to what we talked about in the previous lecture in relation to homemade leverage. Investors can do these things for themselves. They can make these decisions and choose which way to go. Okay, so another potential use of funds is a stock repurchase. Rather than just giving money in dividends out to the shareholders, companies can buy back their own shares of stock. And so it essentially is giving money back out to the shareholders, but it reduces the number of shareholders going forward. So one way that they do this is a tender offer. A tender offer is where they broadcast the news that they are going to offer X dollars per share. The company states a purchase price and a desired numbers of shares. And so usually that purchase price is a little higher than what it's currently trading, and so it's very specific. Then the other way is on the open market. They can buy stock on the open market. They have to disclose that, but it can be done just whatever at the current market price. So similar to a cash dividend, stock repurchases are similar in that it returns cash from the firm to stockholders. And this is another argument for dividend policy irrelevance. In the absence of taxes or other imperfections, it really doesn't matter. You're getting money back into the hands of investors. Now, obviously, when we consider taxes, when you buy a stock from a shareholder, that is a transaction that would result in either a capital gain or loss for that shareholder. If the stock has risen since they originally purchased it, it would be a capital gain and they'd be taxed at capital gains rates. So let's also look at a few real-world considerations. Stock repurchase will allow investors to decide if they want the current cash flow and associated tax consequence. So if it's a tender offer or on the open market, investors don't have to sell. And so only the ones that would be interested in selling are the ones who would participate. The ones who want to stay invested in that company and continue to receive future dividends from that company would not sell, and they would just stay invested in that company. So given our tax structure, repurchases may be more desirable due to the options provided to stockholders. We're talking about the US tax regime and how our investments are taxed. So the IRS recognizes that there could be some reasons why companies would do stock repurchases for the specific reason of allowing investors to avoid taxes. So the IRS does not allow that. They don't allow a stock repurchase for the sole purpose of allowing investors to avoid taxes. So management would have to state some other reason. Maybe they would consider their stock is at a low point or undervalued. And you hear that a lot with stock repurchases. You know, a company has, you know, several $1 billion in cash sitting on the sidelines, and their stock maybe has declined a little bit, but their future looks bright according to management. And so the management may think, well, our stock looks undervalued. Let's use some of this cash. Let's buy back some of the stock while it's low. So information content of stock repurchases. We talked about the information that is associated with dividends. Stock repurchases also have information. So stock repurchases send a positive signal that management believes the current price is low, as I just mentioned. Tender offers send a more positive signal than open market repurchases because the company is stating a specific price, and as I mentioned, that price is going to be above the current market price. The stock price often increases when repurchases are announced. So here's an example of a real-world repurchase announcement, and we'll read through this real quick. So America West Airlines announced that its board of directors has authorized the purchase of up to 2.5 million shares of its Class B common stock on the open market. So this is not a tender offer, but they have stated the number of shares that they want to repurchase on the open market as circumstances warrant over the next 2 years. So as they do this on the open market, they will look for opportunities over the next 2 years when the stock price is maybe taking a dip, and they'll be trying to take advantage of that. Following the approval of the stock repurchase program by the company's board of directors earlier today, W.A. Frank, chairman and chief officer, said, "The stock repurchase program reflects our belief that America West stock may be an attractive investment opportunity for the company, and it underscores our commitment to enhancing long-term shareholder value. The shares will be repurchased with cash on hand, but only if and to the extent the company holds unrestricted cash in excess of $200 million to ensure that an adequate level of cash and cash equivalents is maintained." So here they're saying we're not going to dip below $200,000. We have to have more cash than $200,000 in the bank in order to participate at all in the share repurchase plan that they had. And so that would alleviate any concerns that maybe debt holders would have, and would ensure that there was enough cash for net working capital and other things. So what we know and do not know. Corporations typically will smooth dividends. What I mean by this, our net income at a company will fluctuate. Every quarter, it could be cyclical because we have seasonal variations in our net income. Companies, though, will tend to, rather than have their dividend go up and down with that, they'll just kind of smooth the dividends out so that they're reliable, so that they can be counted upon. That way, the present value of the future cash flows of these dividends can be more easily calculated and improve the value of the stock. Dividends provide information to the market. We've already discussed that. Firms, however, need to follow a sensible dividend policy. And this is what I mean by that. We should not forgo positive NPV projects just to pay a dividend. We should avoid issuing stock to pay dividends. We talked about flotation costs. There are other costs as well. We should consider share repurchases when there are few better uses for the cash. And we've seen a lot of share repurchases. They've become very popular over the recent years. Companies still, of course, continue to pay dividends, but with stockpiles of extra cash, we see a number of stock repurchases. So let's put it all together. So aggregate payouts are massive and have increased over time. We're talking about share repurchases, dividends. They have increased over time. Dividends are concentrated among a small number of large, mature firms. So, and that's true. You don't see a tech startup paying dividends. They need the cash to be able to reinvest. It's the large, established, mature firms that have consistent cash flows and not a lot of room for growth. Maybe they've saturated the market and they don't have a lot of room for major growth. Then they'll take their excess cash and start paying dividends. Managers are reluctant to cut dividends, and we know that because dividends or changes to dividends signals, and managers do not want to send any signal that will affect the share price. We already discussed this. Managers smooth dividends and stock prices react to unanticipated changes in dividends. So if the board announces that dividends will be decreasing because of something that was unexpected, then the markets will react. So how should the management view of dividend policy be? Let's agree or strongly disagree on this. 93.8% try to avoid reducing dividends per share. So 89.6% try to maintain a smooth dividend from year to year. We can see the things we've discussed are relevant and accurate in practice. Only 41.7% pay dividends to attract investors subject to prudent man restrictions. So prudent man restrictions are have to do with the fiduciary responsibilities. And so they're only 41.7% pay dividends to attract those types of investors. What about important or very important? 84.1% say that maintaining consistency with historic dividend policy is important or very important. 71.9% say that the stability of future earnings is important or very important. And 9.3% say that flotation cost to issue new equity is important or very important. So those affect our decisions in setting our dividend policies as management. So finally, let's talk about stock dividends. So stock dividends are where rather than pay out cash, they'll pay additional shares of stock instead of cash. And this will increase the number of shares outstanding in the company. So a small stock dividend is less than 20 to 25%. So if you own 100 shares and the company declared a 10% stock dividend, you would receive an additional 10 shares. So that would be considered a small stock dividend. A large stock dividend is more than 20 to 25%. Finally, let's look at stock splits. Stock splits are essentially the same as a stock dividend, except it's expressed in a ratio. So for example, a 2-for-1 stock split is the same as a 100% stock dividend. That means if I owned 10 shares of stock, then I would end up, after a 2-for-1 stock split, I would get 2 shares for every 1 shares I own, so then I'd have 20 shares of stock. Stock price is reduced when the stock splits. The overall market capitalization for the company remains the same typically, but the stock price, if it's a 2-for-1, would be cut in half. So a common reason or explanation for stock splits is to return the price to a more desirable trading range. What does that mean? Well, as your company grows in value, if you don't split the stock will continue to go up in price. And so what you'll end up having is you will price yourself out of a certain number of investors. Not every investor has the money to invest in a very expensive stock. And here's an example. As of today, which is May 1st, 2020, 1 share of Berkshire Hathaway stock was trading at $277,000. So do you have enough money to buy 1 share of Berkshire Hathaway stock? I don't. I don't have that much cash sitting around. So Berkshire Hathaway is specifically keeping their stock price at that high level because they only want certain types of investors. Other companies will want to make their stock more easy for the average investor to buy. And so they'll keep their stock in a specific range, and they do that by just splitting the stock. So they don't destroy value, and it's not a bad thing if you own stock and the stock splits. I might have a stock worth $10 a share, and I've got 10 shares, that's $100. If they do a 2-for-1, then I'll have 20 shares worth $5 each. It's still worth $100. So it didn't change the overall value of my original investment. It just changes the number of shares and the share price. So here's an example that I pulled in regards to stock splits, and I wanted to give this example in terms of Apple Computer. So Apple came out, they issued their first, the initial public offering was in 1980, and it launched at the end of 1980, and an investor who purchased 10 shares of Apple would have purchased them at $22 per share. That was the IPO. So you would have had to pay $220 for 10 shares of Apple. So 4 stock splits, and nearly 30 years later, that same investor would own approximately 560 shares. So we'll go through that value. Okay, so in 1987, they did a 2-for-1 stock split. So mathematically speaking, that initial $220 had grown to a worth of $830, but now we would own 20 shares instead of our original 10 shares. So they split it. Before the split, it was worth over $80. After the split, it was worth just over $40 a share. In the year 2000, they did another 2-for-1 stock split. So at this point, the original 10-share investment would have ballooned to 40 shares of stock, each valued at $101 at the close of market. So the initial investment would be worth $4,050. So we initially invested $220, now it's worth $4,050. 2005, we had another 2-for-1 stock split. Here we now have 80 shares valued at $44 each. Our initial investment would then be worth, it went down, as you can see, $3,588. 2014, let's fast forward. They've had a lot of success since then. Stock or the value of the company has gone up significantly. After that, we would have owned 560 shares, each valued at $93.70, making our initial 10-share investment, which was $220, now worth $52,472. So present day, this isn't quite present day. I think this is 2 years ago. Yeah, so in 2018, it was worth $200. I think it's somewhere around $220 or $230 now. At that price, an initial investment of $220 in this should be 10 shares would be worth $112,000. So this is the power of stock investing. Not every company is a home run like Apple, but if we can invest in good companies and hold on to them, then this is the potential that stock has. So you can see the rate of return that we would have received would have been 51,000%. So the stock splits did not affect the value in the price, sorry, the increase in the value of our investment. It didn't rise to 112,000 because of the stock splits. All the stock splits do is it affects what is the current share price. It affects at what share price it is trading. And companies can also do reverse stock splits. Okay, so we'll end there. I encourage you to do the quick quiz on your own. If you can't answer the questions based on what you've heard in this lecture, I would also recommend searching the book. If you have additional questions after reviewing this lecture and the book, then feel free to contact me during my office hours. Also, I would encourage everybody to take a stab at the comprehensive problem, the answer to which is in the notes section of the PowerPoint slide, which you can download. Thank you very much. I hope this was helpful.